So today, let's pull back a bit. Instead of looking at individual companies, we're going to take a macro view of the entire AI ecosystem. We're going to trace the flow of money and power to really understand where durable, long-term value is being created, and more importantly, where it's being captured.
You know, with all the hype flying around, there's this one fundamental question that every single founder, investor, and strategist out there really needs to answer. Is the real, lasting value going to be in building the foundational infrastructure that powers all of this AI, or is it in the shiny applications that we all interact with every day?
And that, of course, leads to an even bigger question. Because wherever value gets captured, that's where power starts to concentrate. And if you can understand that, you have a real shot at predicting who the long-term giants of this whole technological revolution are going to be. Okay, let's get into it.
All right, so here's our game plan. We'll kick things off by defining the key layers of the AI stack, and you'll see it's a bit more complex than you might think. Then we'll dig into the economics that shape these layers, figure out where the real leverage is, and then turn all of that into a practical playbook before we reveal our final power map.
Okay, first things first. Before we can figure out where the value is going, we have to agree on the terms. We need to clearly define the battlefield, so to speak. So the traditional way to look at this is pretty simple, right? A two-part stack. On one side, you've got the AI infrastructure, the companies making the chips, the GPUs, the cloud platforms, all the stuff that enables intelligence. On the other side, you have AI applications, the SaaS tools, the consumer products that package all that intelligence up for us. But here's the thing, that view is missing the most disruptive force in the game. Right there in the middle, you have this crucial third layer, the foundation models themselves. They are the intelligence engines. Now, all three of these layers make money. But as we're about to see, they capture value in completely different ways.
All right, let's do what they always say, follow the money. Because the economics of capital, cost, and competition, well, that's the bedrock that dictates the structure of this entire market.
And the key idea we need to grab onto here is something called capital intensity. It's a simple concept, really. It just means how much cash does it take to even get in the game. A business with super high capital intensity, like, say, building a chip factory, requires billions of dollars before you've even sold a single thing. And that naturally creates an incredibly high barrier to entry.
And right here, you can see that split in black and white. The infrastructure layer, it has just astronomical capital intensity. We're talking billions for hardware and R&D. And the result is a really consolidated market with only a handful of players. The application layer is the complete opposite. You need relatively little capital to get started. You can rent compute, fine-tune a model fairly cheaply, and that leads to a flood of competition. And what about that middle layer, the foundation models? Well, it sits somewhere in between, but the capital it needs is still immense. We're talking hundreds of millions for just one training run, and that creates its own pretty powerful barrier to entry. So, what's the big takeaway here? It's simple, really. The sheer cost to compete at the infrastructure and model layers almost guarantees that they're going to be concentrated markets. And that is our first major clue in our search for where power ultimately ends up. Okay, so we've got the cost structure down. Now let's shift gears from money to, well, to control. It's not just about who has the capital, it's about who has the leverage. Who's really holding the winning cards in this game? Just think for a second about the business models here. Infrastructure providers, they're selling the picks and shovels in this gold rush. So as the entire AI ecosystem grows, their revenue just scales right along with it. Applications, on the other hand, are stuck in that hyper-competitive world we just talked about. They face constant downward pressure on their prices. To put it another way, infrastructure players can capture rent, while application players are forced to compete on margin.
And that word I just used, rent, that's the real prize here. It's what everyone is fighting for. It's that excess profit you get to earn simply because you have some kind of structural advantage. Some sort of scarcity or power that protects you from the brutal forces of perfect competition.
So what this boils down to are two very different kinds of power. Infrastructure's leverage comes from pure scarcity. There's a limited supply of high-end GPUs, limited chip manufacturing capacity. It's a deep structural kind of leverage. And applications leverage, on the other hand, comes from distribution, a massive user base, or being deeply integrated into a company's workflow. This is a scalable advantage for sure, but it's one you have to constantly defend. And the foundation models in the middle, they have a third, totally unique kind of leverage, platform power. They control the API, the whole developer ecosystem, and the core intelligence that everyone else is trying to build on. And that really is the bottom line, isn't it? When you control a scarce resource, whether it's a chip, a developer platform, or a captive audience,
You get the power to set the price. That is the fundamental advantage we're looking for.
You know, this whole thing, it's not exactly a new story. History shows us this pattern again and again. In the gold rush, it was the people selling the shovels who made the most consistent money. In the internet era, it was the cloud infrastructure providers who became dominant. And in the mobile era, it was the platform owners, Apple and Google, who ended up capturing a huge chunk of the value. So the question for us is, in this AI era, which of these patterns is going to repeat itself and where?
All right, so that's the theory. But what does this actually mean for the people on the ground? Let's translate all these ideas into a straightforward, actionable playbook for the people building companies and investing capital in this space.
So if you're a founder building an application, this whole framework should force you to ask a really tough question. Is your only advantage that you have smart AI? Because in a layer that's flooded with competition, being just a thin wrapper around somebody else's model, well, that's not going to be enough. Your real defensible moat has to come from something else. Embedding your tools so deep into a workflow that it's impossible to rip out. Owning your customer relationship directly, or creating ridiculously high switching costs.
And for investors, it's a similar kind of question, just from a different angle. You have to ask, where in this new three-layer stack can I find durable leverage? Are you betting on the stable, rent-seeking nature of infrastructure, the explosive winner-take-all potential of a dominant foundation model, or the viral, but maybe fleeting, growth of a breakout application? The most valuable investments in the long run will be in the companies that manage to control a critical bottleneck in the system, no matter which layer they're in.
Seriously, let that be your mantra here. Find the bottleneck, that choke point that everyone else in the ecosystem has to go through, and I promise you, you will find the source of long-term power and value.
Okay, time to put all the pieces together. Based on our analysis of capital, of scarcity, of leverage, what is the most likely structure of the AI ecosystem once it starts to mature? Let's go ahead and draw the final power map.
So based on everything we've talked about, this is the most likely outcome we've been building towards. At the very bottom, the infrastructure layer is going to be highly concentrated, with just a few dominant players capturing a steady, consistent rent from the entire ecosystem. At the top, the application layer is going to stay highly competitive and fragmented, where individual companies might capture these incredible episodic spikes of value. And right there in the middle, you have that all-important foundation model layer, which will be semi-concentrated, acting as a powerful platform that shapes everything built on top of it.
So really, the biggest takeaway from all of this is pretty clear. Long-term success in the age of AI isn't going to come from just building the smartest model or the cleverest application. The true enduring winners will be the ones who understand and control the critical leverage points across this entire ecosystem.
And that really brings us to the final question, the one I'm going to leave with you. Now that you have this three-layer map of power and value, if you were deploying your capital, your time, or even your career today, where would you place your bet? On the picks and shovels of infrastructure, the king-making platforms of foundation models, or in the wild, chaotic gold rush of applications? The answer to that question is going to define the next decade of technology.